everyone, welcome to today's video in regards to the upcoming earnings report by the streaming leader Netflix, the popular streaming service company. The quarterly results are expected on Tuesday, April 18th, after Wall Street close. This video is recorded nearly a week in advance. It is today, Thursday, April the 13th. I'm your host, Nikos Zabouras, Senior Market Specialist at FXCM. Before we begin, however, with this video, please, as always, read carefully through the risk warnings and the disclaimers, and then we will get started. Once again, please read carefully the risk warning and the disclaimer, and also please bear in mind that anything that is discussed in this video does not constitute investment advice, and it should not be construed as such. Okay, let's get the ball rolling. So, as we said, it is Thursday, April the 13th at the time of recording, little less than a week ahead of the earnings report by Netflix. The streaming giant had a very bad first half of 2022 in terms of both metrics and stock performance, but things improved in the back half of that year, and its stock had a profitable first quarter of 2023. In today's video, we will talk about that mixed backdrop and then move into the projections for Q1 and some key topics, some key themes that I will be looking forward on next week's earnings report. So let's start from the backdrop, go a little bit back in time and see what has happened over the last year or so around the company and its stock. And let's start with the bad. Netflix faced a negative external environment. It was the poster child of the pandemic era, as lockdowns kept people home and turned them to online services such as the one offered by Netflix. But last year, the world had moved away from these lockdowns, and people started going out. Cinemas seem to be rebounding, and that, of course, was not favorable for the streaming giant. Furthermore, the surge in inflation also is not good for the company, since it diminishes disposable income, and when this happens, people are probably gonna cut from such non-essential services rather than other more important ones. And the tech sector as a whole and growth stocks are more exposed to high interest rates. And last year, the Fed delivered a massive 425 basis points worth of hike, which of course continue well into the years, although it looks like it's ready to reach the peak. It's close to peaking. Now, other than that, there's increased competition in the streaming market. And the firm actually acknowledged this around this time last year as one of the factors that have negative impact on its growth, noting that over the last 3 years as traditional entertainment companies realize streaming is the future. Many new streaming services have also launched. That's what the company said around a year ago. And indeed, of course, legacy entertainment giants and tech behemoths push on the streaming front. Warner Bros. Discovery has HBO and decades worth of compelling content. Paramount has also thrown its hat in the arena. Of course, Paramount has the blockbuster Top Gun sequel, while tech giants Amazon and Apple have also produced original shows that drew the attention of both viewers and critics. Of course, the main competitor is Disney and Disney Plus, which has seen meteoric rise since it launched in late 2019, supplemented, of course, by Hulu and the sport-oriented ESPN, which are the 3 streaming services of the Walt Disney Company. Of course, Disney owns 2 of the biggest franchises in Hollywood, Star Wars and the Marvel Cinematic Universe, so it definitely has a compelling offering. Now, Netflix relinquished subscribers in the first quarter of last year, of 2022, for the first time since 2011, and losses widened in the second quarter of that year, with its user base reduced by more than 1 million members in the first half of 2022. Disney, of course, took advantage of this and knocked Netflix off the top spot over the summer and has stayed ahead since. As of the end of December, Disney's streaming suite had 234.7 million users, while Netflix was behind with 230.75 million subscribers. Now, these subscriber losses and slowdown in revenue growth was detrimental, of course, to the stock, which lost half of its value last year and set 5-year lows in May. And let's actually bring our chart forward so that we can see that. So if we take a look on the chart, let's expand a little bit. So what do we see here? First of all, here on the left, this is early last year during the Q4 results, when it had offered disappointing guidance. It had said that it expected around 2.5 million net additions for the first quarter, and that was far less than what it had been providing up until that point. And you can see that that markets react negatively and the stock slumped. And then, of course, around this time last year, we had the actual Q1 results, which showed that the firm relinquished 200,000 users during the first quarter, and then the stock slumped again, and it actually hit 5-year lows in May. So that is the bad. Okay, so now let's go to the good. So let's bring our presentation forward again. So what went well last year? During the last 2 quarters of 2022, Netflix turned things around and returned to user growth. And it actually ended 2022 with the net addition of 8.91 million users. So yes, it lost subscribers during the first half. That was a shock, but it returned to subscriber growth, and overall for the year, it was net positive in terms of its the expansion of its user base. And of course, the company did not sit still while these bad developments were going on. It actually rethinked key aspects of its strategy, and most important, the inclusion of advertisements, which is something that other streamers have been doing, but Netflix had resisting for a long time. However, we will talk about more about that, the ad-supported year, at the last segment of this video, where since it will be some of the focal points of the expected Q1 results this time around. Netflix also managed to post record revenues despite slowing growth on a quarterly basis. The firm was still able to post record figures last year in terms of revenues, and also the stock rebounded after bottoming out in May 2022. And let's bring the chart up again to show actually this thing. You can see here how, as we said, the stock bottomed out here in May, as we talked about, but then you can see that it started actually rebounding, and this recovery extends into the current year, as Q1 was the third straight profitable quarter, up nearly 20%. In terms of the technical aspect, you can see that it tested the 38.2% Fibonacci of the drop from the 2021 record highs to the 2022 multi-year lows that we talked about. However, it rejected this level, and this keeps it in a, let's say, precarious positions. Although on the upside, it has also formed a golden cross, a technical formation that can often be viewed as a precursor to further gains. Of course, we need to be cautious around that. A golden cross is when a faster EMA crosses above exponential moving average, crosses above a slower exponential moving average. In this case, the fast is the 50 days EMA, and the slow is at 200 days EMA. So that's what was good last year. Now let's move on what we expect, or actually the company itself expects for the first quarter, and some of the things that will be in our radar. Now, as we said, the Q1 results are expected on Tuesday, April 18th, in less than a week from the time of recording this video, after, of course, US close as usual. Now, the company projects revenues of $8.172 billion, which is better performance compared to last quarter, anemic 3.9% growth, but still not a very good, relatively low percentage for Netflix's standards. Now, in terms of earnings per share, this will be, again, the company, these are the company's own projections. This figure will be a massive improvement from the 0.12% or $0.12 per share, but smaller compared to Q1, Q2, and Q3 of 2022. And expected net income is at 1.275 billion. The fourth quarter, during the fourth quarter, it barely broke into profits. So that's definitely going to be a significant improvement if it materializes. And now let's see what will be in my focus. Some of the areas, of course, there are many aspects to such results, but some of the things that I will be looking for are the ones that you can see here. And let's expand a little bit. Now, Netflix has stopped offering guidance over subscribers, and has also recently downplayed the importance of these metrics as it develops additional revenue streams, where membership is just one component of the company's growth, the other being advertising and paid sharing, just to name a few. However, I still want to see how its user base evolves, and if the new numbers that it will release will give Netflix a chance to reclaim the first place. Disney, of course, report later on, so that's what we will actually know, but a good figure may give it a fighting chance, but we're going to have to wait and see. Now, the other thing is that what we already talked about, the ad-supported tier. Netflix started offering a new, cheaper subscription plan with the inclusion of advertisements. It was also able to undercut rival Disney in both timing and pricing, because it launched in November, while Disney a month later, and the new plan was priced in at $6.9, while Disney was a full dollar higher for Disney Plus. Now, Netflix did not disclose how many users it had on this plan in its previous earnings report. So I want to see if it will do so this time around. What it did say in the last earnings report, though, at the beginning of the year, is that the company is pleased with the progress across every dimension on this offering. And what was quite important was that it didn't see any switching from other plans, meaning that subscribers on the non-ad-free, ad-including plans, the ones that don't have advertisements, did not switch to this cheaper plan. The company also expects that this will generate incremental revenue and profit in 2023. So it's not going to be a big thing this year, but it will build slowly over time. CFO Adam Spencer, during that earnings call, said that they wouldn't get into the business if they didn't believe that they could get at least 10% of revenue from this ad-supported plan. During the same earnings call, co-CEO Ted Sarandos was also asked about a fast service, which is what is referred to when we have free ad-supported options, meaning someone can subscribe to Netflix for free for some form of content that will also include advertisements. Essentially, what the co-CEO said that he is open to such a plan, but it's probably too early to talk about that, as there are other priorities. Now, the other thing is what is going on with the firm's effort to crack down on password sharing. Password sharing had allowed the firm to grow at the beginning, but now create headwinds to its revenue. In January, the firm said that the widespread account sharing over 100 million households undermines the long-term ability to invest and to improve Netflix. So the company has tried various approaches to monetize on password sharing, with Latin America being the main testing ground. The company expects to start rolling out paid sharing more broadly in the first quarter, expected that in the first quarter, which has now elapsed. So we want to see if they will offer more insights into that and how this has actually been received. And the other one, perhaps a little bit less important, but I think it's interesting to see the intentions there, is sports, offering sports. Rival Disney owns the sports channel ESPN and the relevant streaming service ESPN Plus, and highlighting the importance of this segment, ESPN will now get its own segment based on the recently announced restructuring plan. So it will be its own reporting segment within the structure of the Walt Disney Company. Amazon and Apple also offer sports such as baseball and NFL. YouTube TV also got into NFL, got the national ticket. So it would seem reasonable for Netflix at some point to look into this market and tap into this market as well. It does not have anything like that at the point. During the last earnings call, co-CEO Ted Sarandos said that it's not that they're anti-sports for profits, but they haven't been able to figure out a way to deliver profits from such big sporting events. And he is open to that. So we'll see if during the earnings call he will get asked about something like that again, and if there's any developments there. So that's pretty much it. Again, the results are expected on Tuesday, April 18th, after Wall Street closes. Netflix has been able to turn things around and will be eagerly awaiting those results for those things that we discussed. So that's it for me. Thank you for joining me.